Hello everybody, welcome back to our channel. We're so excited to share with you a stock that Jim Cramer has been newly initiated and he kept mentioning about the stock in the last 3 weeks. Now let's look at his charitable trust holding account. The last date he bought it on March 14th, on March 13th, on March 11th, on March 10th, on March 7th, and on March 6th when he initiated on this stock. Now listen to what he's saying.
Buying more Capital One, just been nibbling each day. Well, today you actually got an upgrade over at Baird. They raised their rating to outperform. Price target goes to 200. They're believers in the long-term synergies, says it's not reflected in the stock price or the Discover deal. They say the recent weakness has resulted in an opportunity to buy a business that should be one of the most profitable, risk-adjusted returns in credit-sensitive financials over the next several years.
My reason what I was drawn to it was because it's switching from being a bank to being a fintech, in that they are able to take all the fees they pay MasterCard and Visa and run it through their own system. And I don't think people realize that this is a coloration change. Now, remember, Capital One is a very confusing situation that we're taking advantage of. I've known Richard Fairbanks as CEO for decades. Now, here's the problem with Capital One. The deal hasn't closed.
Sure. Waiting for the Fed, waiting for the OCC.
Right. And when it closes, numbers are going to go up huge, and the analysts are going to get all behind it because they're going to say, hey, we got a company that is no longer just a bank. And that's what we need to see.
For those who doesn't know Capital One Financial Corp., Capital One is a diversified financial services holding company. The company offers a range of financial products and services to consumers, small businesses, and commercial clients through digital channels, branch locations, cafes, and other distribution channels, and headquartered in McLean, Virginia. Originally a spinoff of Signet Financial's credit card division in 1994, the company is now primarily involved in credit card lending, auto loans, and commercial lending. Capital One shares were down nearly 20% from its highs, creating an attractive opportunity to buy shares of a company that is expected to complete a game-changing acquisition in a few months. The company's pending acquisition of Discover Financial Services is a major potential catalyst that will fundamentally improve the stock. The main strategic advantage is that Capital One will own the Discover Global Network, which will scale up and become a vertically integrated global payments platform. By owning a network, Capital One will decrease its reliance on MasterCard and Visa, lowering what it pays out in fees. And by having a direct relationship instead of dealing with intermediaries, Capital One can create more value for merchants, small businesses, and consumers. For example, Capital One will be able to provide merchants with better fraud management and transaction data, which they can use to drive more sales. The deal is also expected to generate $2.7 billion in expense and network synergies. Before we continue, if you find any value in this, can you please smash the like button? It literally costs nothing, but it helps the channel out so much. And make sure to subscribe our channel so you don't miss out on any new contents like this. We are not financial advisors, so you always do your own due diligence. Now let's take a look at financial strength. Despite its exposure to credit cards and auto loans, we believe that Capital One is in a very strong financial position. At the end of December 2024, Capital One had a common equity tier 1 ratio of 13.5%, up from 12.9% last year, and well above its long-term goal of 11%. This is despite Capital One building additional reserves in 2023 and 2024, with its allowance for bad loans now at 4.96% of existing receivables. We expect Capital One to remain overcapitalized in the immediate future as it works to acquire and then integrate Discover. Once this process is completed, we see ample room for the firm to return more value to shareholders while maintaining a strong financial position. These figures do need to be viewed in the context of Capital One's exposure to subprime credit cards and subprime auto loans. Roughly 31% of the bank's domestic credit card portfolio is with cardholders whose FICO scores were below 660, and a similar portion of its auto loans is from borrowers with FICO scores below 620. Additionally, we foresee higher credit costs for Capital One in 2023 and beyond as higher debt levels, higher interest rates, and elevated prices for goods and services pressure consumer credit quality. We expect credit card net charge-offs to remain modestly elevated in 2025, coming in at 5.6% for the full year. That said, the bank should be able to easily withstand this level of losses, and we expect credit quality to begin to improve by the end of the year. Now let's discuss the business strategy. Capital One maintains a more limited branch network than its traditional banking peers, using its online and mobile channels to acquire customers and service its accounts. The focus on online bank accounts has allowed the company to establish a national presence broader than what its narrow branch network would traditionally allow. This dynamic allows Capital One to enjoy the benefits of being a large bank without the expense of operating the branch system of a large bank. Capital One's largest driver is its credit cards, which make up around half of its total loans. The bank's remaining business mostly consists of commercial loans and auto loans through its consumer banking segment. The bank's narrow product offering focuses its assets, giving Capital One the benefit of scale in its chosen business lines. It is worth noting that the firm's acquisition of Discover, once completed, will significantly increase its exposure to the credit card industry, reducing its level of diversification. Capital One's credit card receivable balances increased around 5% in 2024, despite the rising credit costs and lower loan growth seen industry-wide thanks to its heavy marketing spending. The bank will need to compete aggressively with other credit card issuers to maintain this growth, particularly as it expands more aggressively into luxury travel cards. Capital One is doubling down on the credit card space, with the company's plans to acquire Discover set to make it the largest card issuer in the U.S. by receivables. We are generally favorable on the acquisition as we think Capital One is getting a fair price for the assets and there is strategic value to the deal thanks to Discover's vertically integrated ATM and payment networks. On a less positive note, credit costs rose significantly in 2023 and 2024 as economic pressure on its cardholder base increased due to the impact of higher interest rates and as the end of student debt forbearance filters through. However, Capital One remains in a healthy financial position, and there are signs that net charge-offs will plateau soon. As a result, we do not foresee material financial strain. Capital One got another bull on board after analysts at Baird upgraded their rating on the stock to outperform and raised their price target to $200 from $190. Baird said, "We are upgrading Capital One to outperform as we believe recent weakness has resulted in an opportunity to buy a business that should be one of the most profitable risk-adjusted returns in credit-sensitive financials over the next several years." Added, Capital One's credit card portfolio is enjoying rapid growth, providing a boost to the company's net interest margins and revenue growth. Capital One has expanded its card product offerings as the bank leans into the commercial and luxury travel card spaces. The future outlook for Capital One stock appears cautiously optimistic. Analysts have given it a consensus rating of moderate buy, with price targets ranging from $165 to $257. The average price target suggests a potential upside of around 25.76% from its current price. Factors like improving consumer credit metrics and potential economic stability could positively impact its performance. However, challenges such as rising credit card debt and interest rates may pose risks. Our price target on the stock is $210. Our price target estimate also includes modeling for the strategic value of Capital One's proposal to acquire Discover. The bulk of this value comes from cost savings, as Capital One plans to transfer $175 billion in purchasing volume to the Discover network by 2027, which would include all of Capital One's debit card business. This will allow the bank to bolster the scale of the Discover payment network while also saving on network fees, with Capital One expecting $1.2 billion in additional cost savings from network synergies. This strikes us as a reliable method to extract value from the deal, as the combined company benefits from being vertically integrated. The company is sensitive to expectations for net interest margins, credit card receivable growth, and how well the company manages its non-interest expenses. Additionally, net charge-offs projections are a key driver of our fair value estimate, particularly for the bank's lucrative credit card loans. We expect credit costs to remain modestly elevated in 2025. Our current projections assume that the firm-wide net charge-off rate remains at 3.21% in 2025, before returning to 2.83% by 2027. Note that this does not include the impact of the Discover acquisition, which will shift Capital One's asset mix toward credit cards, naturally leading to a higher firm-wide default rate. Despite higher loan losses, We expect Capital One to be more than adequately provisioned with its current reserve for loan losses at just under 4.96%, as well as a Common Equity Tier 1 capital ratio around 13.5%, and do not foresee material financial strain on the bank. As we had expected, the double-digit credit card loan growth seen in 2023 was not sustainable as higher credit losses have led to tighter underwriting standards, which constricts growth in the medium term. That said, loan growth has been surprisingly resilient, and we expect credit card receivables to grow at an average rate of around 5.8% a year, from 2023 to 2028, with firm-wide loans increasing at a 4% CAGR over the same time period. While Capital One's recent growth has been impressive, this growth did not come cheap as Capital One has significantly increased its marketing spending, up more than 55% in 2024 from 2021 levels. While we do expect marketing spending growth to slow down going forward, it should remain at elevated levels as the bank seeks to break into the luxury card space and restart growth in its auto lending business. All in all, we see the company's efficiency ratio ending 2028 at around 56%, roughly in line with historical levels. The balance sheet remains strong, with a Common Equity Tier 1 capital ratio of 13.5% at the end of December 2024, well above the long-term target of 11%. The company is also conservatively provisioned, with its allowance for bad loans at around 4.96% of total receivables. This strength will likely see it through the current period of high credit losses and allow it to continue to return value to shareholders once the Discover deal is completed. Capital One has a history of making acquisitions that fit its strategic goals. The purchase of ING Direct in 2012 jump-started its direct banking efforts while adding considerable scale. This was followed by continued investments in technology, enabling the low branch count banking model. The company has also shown discipline when allocating its capital. It chose to fully exit its consumer real estate business in 2017 when it decided it did not have the scale to compete efficiently in a low-rate environment. Capital One's commitment to efficient capital allocation is encouraging and adds confidence that the company will continue to invest its capital intelligently. This discipline remains an important part of Capital One's ability to create value for shareholders, as the company has made increasing use of acquired credit card portfolios to bolster receivable growth. Capital One has doubled down on the credit card space as its proposed acquisition of Discover would make it the largest card issuer in the U.S. by receivables and third by purchasing volume. In general, we have a favorable view of the transaction, as Capital One is taking advantage of Discover's recent issues to acquire the other firm at a fair price, and we do see some strategic value to the combination. While there were initially concerns that the deal would run into antitrust issues, this has not materialized, and it appears highly likely that the deal will proceed in early 2025 as planned. Capital One's stock has garnered significant interest from investors, driven by its strong financial performance and positive market sentiment. With analysts projecting a potential upside of over 25% and a sentiment score ranking in the 96th percentile among its peers, the stock presents an attractive opportunity. Its consistent growth trajectory and strategic initiatives further solidify its appeal, making it a compelling choice for those seeking value in the financial sector. What are your thoughts on the stock? Would you agree with Cramer? Is it time to buy it now? Please leave us some comments down below. Share your thoughts. Thank you for watching.